Hey guys, Sonya Bersani here with Legend Lending. So today I'm going to get pretty geeky with you. I love numbers, I love digging deep into them, and today I'm going to show you how the mortgage interest deduction actually works when it comes to impacting your tax refund or your tax liability at the end of the year. Now, full disclosure, I am not an accountant. Always refer to your accountant for case-specific info. I wanted to just kind of give you this insight so you have an idea of how it works and how it impacts you as a homeowner. With all the changes we've seen over the years, we've seen it actually phasing more and more out that there is a big impact with the mortgage interest tax deduction, but it certainly has its place and you need to pay attention to it when you're making your decisions on being a home buyer. So let me jump into it. In this scenario, just so you know, I'm taking a case of a single guy, single gal, making about $100,000 a year, buying their first home, borrowing $300,000 and seeing where that lands them. So let's jump on into it. So the first thing you want to keep in mind is that there are 7 different brackets of taxable income. So the first thing is to figure out where you fall on those in those brackets. Now, the IRS does allow what's called your standard deduction. All right. So when we're talking about mortgage interest is a deduction you can take from your taxable income to lower your tax basis, but it's an itemization, which means if you opt to exercise the right to use mortgage interest in an effort to lower your tax liability, you're bypassing your standard deduction. The standard deduction is essentially the IRS's way of saying, hey, we think that at your income, this is an appropriate amount of money to knock off your taxable income for the cost of living and such. So you have to make a decision and compare the numbers, whether itemizing your expenses is better than just taking the flat old standard deduction. So I'm going through both scenarios to give you a good idea of that. But if you're going to take the standard deduction, that's pretty straightforward, and that's what my top example is. So let's go ahead and take a look at this one first. So again, somebody making $100,000, they're going to go ahead and take that standard deduction. The standard deduction is $12,550 as of right now, and that kind of stuff changes year to year. But if you take that deduction, that $12,550 off of your income, that puts your taxable income at $87,450. If you look on the IRS's website, you'll see all the taxable brackets. But that $87,450 is going to land you in this bucket, which is between $86,376 and $164,925, which puts you in a tax bracket of 24%. Now, here's the thing. That 24%, you're not going to spend 24% of your total income. They're not just going to take the full 100 or even the adjusted number and just tax you 24% of that. They tier it in. So what they do is they say if you fall into this tax bracket, you're right off the bat, you're going to pay $14,751. You're paying that, okay? And then on top of that, you're going to pay 24%, which is your taxable bracket, 24% of any amount of money you've made over the base, which is that $86,376. So in this instance, because my taxable income back here I reduced by my standard deduction, my actual adjusted income for taxable purposes is $87,450, okay? So that $87,450, if I look at that compared to what the baseline was of $86,376, what they're saying is you're going to pay 24% on that difference. So it's only like $1,000. So 24% of that is $257. So for this standard deduction example, we're going to take the base tax we had to pay of $14,751, and then the adjustment for 24% over their base, which is $257.76. Add those together, here's your total tax, $15,026. Okay, that's your standard deduction. Really, really simple. You can't combine them though. You can't go taking additional itemized expenses on top of that. So you opt in or you opt out. And again, single filer, those deductions are hired for married couples or head of household potentially. Down here, I did an example if you itemize. Now, I'm itemizing on a super conservative basis. I am just counting the mortgage interest and the property taxes. Now, you may have mortgage insurance you may be eligible to deduct. You may have prepaid some interest. There could be some other things that you can add into your itemization. And certainly, if you have a job that allots the ability for you to itemize some expenses, all of that is put into the pie. So if you're going to itemize other things or you're able to, it could really add up and get you into a good position. But let me just show you again, based off of interest and taxes, what that would do. So again, we take our $100,000. Now we're going to reduce it by our actual itemized expenses. So you would have paid on, say, a $300,000 loan, 3.5% rate, just shy of $6,000 for the whole year, so $5,900, and then for taxes, maybe you paid $8,500 for the whole year. So if I just take those two, again, I wanted to make this pretty simple, but there could be more, and there usually are. If you take those away from your total income, your taxable income then drops down to $85,600, okay? Now, when that income comes into play, all of a sudden, you fall into a slightly lower taxable category or bracket. That bracket's from $40,526 up to $86,375. So again, adjusted income, we're at 85, the cap was 86, so you're squeaking right in, and now you're taxable at 22%. But again, just like with the standard deduction, there is a baseline of taxes you're going to pay no matter what. So if you look down here, that baseline of taxes, $46.64, a lot different than the one up here, right? So you're talking about 10 grand of a difference just in your base taxes. But then you do have 22% of whatever the difference is between the base of that bracket, the 40 grand, and what you actually are showing as your adjusted income. So if you do that math, take away take your income less the base here, 22% of that differential is $9,900, okay? Again, if you had more itemized expenses, that number is going to be smaller and smaller, right? Because you're compounding it. But again, baseline, I just squeaked you into this next bracket. So if you look at it from that angle, it's $9,900 for the difference of your income above the base, plus your base taxes that you're going to pay. So that total comes to $14,580. So just stop and look for a minute. There's really not much of a difference, right? The actual difference is right down here, $446 of taxes you're going to pay. Like I said, the itemized deductions can really pay off big if you compound them, if you have other things that you're going to pay. But nonetheless, you know, there's some room there, and there's an argument to be made that mortgage interest is starting to phase out as being a real benefit for a lot of homeowners. But I think this example might help create some clarity for you to understand how it works. And keep in mind, again, these things can change year to year. So you always want to keep in touch with your accountant to make sure you're getting the most current information. But I sure hope this is helpful. And of course, if there's ever anything my team or I could do for you, feel free to reach out. Take care.